Hello everyone. Good morning, good afternoon, good evening. My name is Hoda Mehr. I am founder and CEO of StockCard. And today we're going to talk about Dropbox, ticker DBX. This is a company that a lot of you guys asked for it in the votes on YouTube and Twitter as a part of our 100 bagger stock analysis series. And it's interesting to see that it is stock. Always shows up on a StockCard's possible 100 baggers a screener. But this is a screener that we created on the stock card, and we use some of the most important criteria or characteristics of companies that historically have resulted in 100x return at least, and we use those criteria and look for companies that have those criteria across the entire stocks that are listed in the United States. And basically it's a really good starting point to find some of those potential candidates for our 100 bagger stock researches. So when you go to this screener, Dropbox always shows up in this screener. The screener refreshes every night, but Dropbox is a cornerstone of this screener and always shows up. So without further ado, let's figure this out. If you've seen the 100 bagger series on our YouTube channel, you know that we use a 7-part framework. This is based on Chris Meyer's book that I've been enhancing over the course of months. And we look at 7 important criteria of the company, whether it has the small enough market cap, does it have a history of growing its revenue, does it have history of expanding its earnings power, does it generate free cash flow so it can be invested into its business? Do we have an opportunity to buy the stock at a good valuation at this point? How is the quality of the leadership team? Do they have a skin in the game to grow the company? And last but not least, we look at competitive advantage, moat, or sources of strengths in the company's operations. So let's do the same analysis for Dropbox. The first thing we want to look at Dropbox is whether it's small enough to grow its operations. So for that, let's go to a Dropbox stock card. If you're watching it now and you're in front of your computer or on your mobile phone, I highly recommend pull up Dropbox the stock card and do the research with me. It's a really good fun exercise as we do it together. And of course, make sure to put your comments and questions and ideas as you do the research with me in the comment section so we can have a conversation. So in terms of size, if we scroll down to the introduction section, we see that Dropbox market cap as of the date that I'm recording this episode, it's about $6.5 billion in market cap. All right, so if you have a $6.5 billion in market cap, in order to generate 100 times return, you need to become a $650 million company in terms of market cap. So the number one thing that I ask myself every time I come across one of these companies that need hundreds and hundreds of billions of market cap, I ask myself whether the market that this company operates in has actually enough capacity in terms of market cap in order for that company to grow and become a $650 million company. So Dropbox operates obviously in technology sector, as we all know. It also operates in the software sector or market. And the most important part is the cloud storage. So the cloud storage market is the primary market that Dropbox operates in. And in order to figure out how much opportunity exists in the market for Dropbox, we need to look at and see whether there is enough market cap capacity in the cloud storage industry or not. So I looked at the estimated market size of the cloud storage in the next few years. I found this on the Statista. It is going to be a $376 billion market by 2029. So I assumed a price to sales ratio of 3, which is a quite reasonable price to sales ratio for the entire cloud storage market. And I came down to something like $1.13 trillion in market cap potential in cloud storage by 2029. So that gave me the peace of mind that Dropbox actually becomes a $650 billion company and is still there is more in terms of market potential left in the industry. Although mindful of that $650 billion in market cap, that's almost 50% share in the overall market in terms of market cap. So be mindful of that. May or may not be possible, but at least we know there is enough capacity in the market to generate that kind of return. The next thing we want to look at, and I'm going to look at two things at the same time. So does the company have consistent revenue growth, and does the company have history of expanding its earnings power? So if you are researching with me, let's go to the companies, the stock card, and let's go to the financial strength section. A financial strength section is where on a stock card we automatically collect and refresh all the financial information that comes from the company's quarterly and annual reports every night, and we give you a digestible result of all those financial information. So the very first thing is the revenue, and based on 6 different analysis, Dropbox definitely has a good, strong and growing revenue. If you want to get a little bit more detail, on an annual basis is about $2.1 billion in revenue, and quarter over quarter a little bit more than 3x, 3% growth, and on an annual basis about 12 in half or 12.7% in growth. So it is a stable growing company. One thing we need to be mindful of is that the growth rate of the company is lower than the growth rate of the market that it operates in. So the market is expected to grow by 22% per year, but historically in the past quarter, in the past few years, the company has been growing slower than the market. So it is a very rapidly growing company, but it's slower than the market. That's something to be mindful because for the company, in order to become that $650 billion market cap, it needs to be able to grow rapidly years after years, decades. I actually did a quick math for you before recording this episode, and the quick math basically just tells us if Dropbox has a $201 billion in revenue right now, and if it can grow by 25% per year over the course of 7 years, which is almost the end of this decade, its revenue gonna get to $5.7 billion in revenue. And even if we assume a price to sales ratio of 10, so for overall market, we assume price to sales ratio of 3, but for Dropbox, we're assuming price to sales ratio of 10. Its market cap gonna become a $57 billion. It's really good in terms of growth, but it's very, very far from the $650 billion market cap we needed for it to become a 100-bagger. So yes, this company needs to grow for decades and decades. So 7 years is enough, 4 years, 10 years, 15 years, 20 years. Double digit at 25% growth and that the market is growing in order for it to achieve that 100-bagger status. So just be mindful of the magnitude of these sort of growth needed for companies to be able to grow and become a 100-bagger return for you in the portfolio. The third criteria we need to look at for Dropbox, it's its ability to generate earnings, or its ability to expand its earnings power. So for a company like Dropbox that is profitable, as we see on its stock card, it's a little bit more easier to evaluate and answer that question because the company actually generates profit, and we can take a look at its net income or its EBITDA and see what kind of growth rate it has generated for its investor. So I'm scrolling down to the net profit or net income section, and it looks like in terms of growth, its company has been doing quite well. 3-year compound annual growth rate in net income is about 189% per year. That's compound annualized. Year over year 230, and then quarter over quarter about 34. So these are really good signs in terms of profitability and the company's ability to expand in earnings, although we do see that the growth rate is sort of slowing down, especially in a quarter over quarter, but that's not something to be worried about. The part that I actually want to spend a little bit more time is the company's return on equity, because one of the better ways in order to evaluate whether the company can generate earnings for its shareholder is to take a look at return on equity. So what kind of return the shareholders of the company are getting for every dollar that the company earns at its bottom line. And return on equity is always part of our management effectiveness, because these kind of return decisions are the result of the management's effectiveness in allocating their capital into whatever projects, growth projects, acquisition projects, or marketing and sales projects that they have. So when I scroll down to the ROE section of the Dropbox stock card, what I see is a little bit disappointing, because I see the company has basically unclear return on equity on a quarterly basis, and then in the 3 fiscal years ago it had a negative ROE, and 2 fiscal years ago it has again had a negative ROE, and a very significant jump in ROE in the last fiscal year. But sometimes you may look at this and say, oh, this is fantastic, more than 1,000% in ROE. But because it's coming off all these negative ROE return, that tells me there is something wrong with the company's shareholder equity. This sort of negative and a big jump, it tells me, if you think about the math behind return on equity, it's the net income divided by average shareholder equity of the starting of the period and the end of the period, for example, starting of the year to the end of the year. So the denominator of this formula is the shareholder equity. If a company is profitable, as we saw, it has positive net income, how could its return on equity become negative? And that's basically what we need to figure out. It's the puzzle. In my guess is that if we go and look at the company's balance sheet, we'll see that the company has negative shareholder equity, and that's really not good. And that tells me either they have a lot of liabilities that reduces the shareholder equity, or they have significant amount of deferred revenue, meaning that the money that they've earned but they can't recognize until the next year or next quarter, because it's a subscription based business. So this is the company's balance sheet, Dropbox balance sheet, and I got it from off of its investor relations website. This is the latest one that came at the end of the last quarter. And truth be told, it is basically having a negative shareholder deficit or shareholder equity, as we talked about it, almost 600 million. And the part that worries me, it's this $1.4 billion in convertible notes, and this is basically it's the amount of money that they had to raise in order to be able to grow the future of the company or grow their company through convertible notes. And convertible notes typically convert into shareholder common shares when they become due, and that dilutes the existing shareholders even further. So it is a little bit of math and accounting here, but basically, if a company has the ability to expand its earnings power, at the end of the day, you need to see that it can generate return for its shareholders. But for a company like Dropbox, it's a big red flag when we see that they were not able to generate positive return for their shareholders, and actually they've taken on so much convertible notes that they are led to negative shareholder deficit or shareholder equity in the company. So that's a big red flag. This is one of those things that we do want to pay attention to as we monitor this company over the course of years to make sure actually it can turn shareholder equity to positive. And that's really what we are looking for as investors. The next financial information on a company on our 7-part framework is the company's ability to generate free cash flow. Let's look at it quickly on the company's stock card. And free cash flow is, again, it's one of other financial information that you can get from companies' financial statements. And on the company's stock card, on their financial strength, there's a whole section related to free cash flow. Yeah, so this is a really good sign on Dropbox. It basically 3 years ago it had almost 400 million. Now it has 500 million. In this last fiscal quarter, almost more than $700 million in free cash flow. those are really good signs. This free cash flow should gradually translate into positive return on equity for shareholders. That's what we want to monitor, but it's definitely a good sign. Going back to our framework to evaluate Dropbox fitness to become a 100-bagger stock in our portfolio, we have to look at our chance to buy the company at a low valuation. So of course, a valuation using traditional metrics like price to earnings ratio or price to equity ratio, those are not necessarily the best methodologies to get a company's valuation there, but it's an indicator of how expensive or how cheap investors are basically willing to pay for the company's stock at this point. So at this point, when I go to Dropbox the stock card, I see it says it's fairly priced to stock. So that probably means there is a mix of high PE ratio or high PS ratio, price to sales ratio. Some of them are undervalued, some of them overvalued. So in this case, price to earnings ratio of 24 times, which is a little bit higher than the average of the market. S&P 500 overall broad market indexes are around 18 and 19, I believe, in terms of price to equity ratio. So Dropbox is a little bit higher, but not that much expensive. And the price to sales ratio is about 4x, 3.7x, and it's lower than the company's peer group. So that's a really good sign. That's one. It's a little bit more expensive price to earnings ratio and a little bit more cheaper of price to sales ratio of almost 3.7. So that's why we get a good fairly priced on average. It is a good sign, meaning that if you buy it now, you can get a good valuation. But again, be mindful, it's not an extremely cheap stock even at this point. We're down to the last two criteria to evaluate whether Dropbox is a 100-bagger stock or not. The last two is all about the company's leadership skill and company's competitive advantage. When it comes to leadership, if you've been with us in the last few series of the 100-bagger stock analysis, we talked about four criteria that we use to evaluate a company's CEO and the leadership team. Whether they have a skin in the game, whether they have an ability to bring big vision and rally people around themselves, whether they have ability to find capital to grow the company, and whether they have the ability to hire the right people for the right spot. So for Dropbox, the company definitely has its existing founder in place. You could typically go to companies' proxy statements, which they have to file with the SEC, and you can see who is the executive team, who are the leaders of the company, and then you can also see whether they have a skin in the game or not, how much of the company they own. So Drew is the company's original founder, who is also the executive, the CEO of the company. So that gives us really good thumbs up in terms of Drew's personal aspirations and financial aspirations are in alignment with our aspirations and our sort of pockets, because if the company grows in terms of revenue and value, it means more money and more prestige and more recognition for Drew. But I want to tell you something about Drew. He does have about 4% of the company's Class A common shares, so 4% of the company, but he has almost 98% of all the Class B shares, which gives him 73% voting power. So this is basically a bet on Drew and his ability to be able to grow the company. When a CEO, a founder, has such high voting power, it means that he or she can change the direction of the company to whatever direction he wants, and nobody on the board or shareholders can do anything about it, because he basically owns the company from a decision-making and direction point of view. It's a good thumbs up in terms of ownership in terms of a skin in the game, but it also means that the company CEO has a very high voting power, and that might be something that we would want to be mindful of. And the last criteria on our list is, does the company have the competitive advantage or moat in order to become a 100-bagger? So the company has a really good brand. That's one thing. If you have a really good brand, let's say the classic example is Pepsi or Coca-Cola. Those are basically competitive advantages and nobody else can basically compare itself to. And the other thing about a Dropbox that it has a very high gross margin. So gross margin is amount of money left in the company after selling every unit of its product. For Dropbox, if you go to its stock card, and if you go to the company's financial strengths section, there's a section about margins that can give us all sort of margins, gross margins, profit margins, and that kind of margin. And we look for its gross margin, we see it has more than 80% in gross margin. And that's a really, really good sign. Companies that can have really high gross margin, basically it means that they can scale their business at a really rapid scale without the need to increase their costs significantly. And so that's another source of competitive advantage, lower cost of servicing their customers, which gives the company an ability to scale fast. And the last thing that I'm very impressed by Dropbox is that it has several integrations into existing IT infrastructure, because if you want to be the file storage and file sharing solution for the current businesses and consumers, you need to have integration with AWS, which is the Amazon storage product, Microsoft, Google, Alphabet, and many other systems that basically enterprises and consumers use in order to store their file or share their file or edit their file, that kind of stuff. So Dropbox has been very careful about that and have been able to establish these integrations. And integrations give companies product stickiness, right? It means that the customers won't just move to another service provider. They've already have Dropbox integrated into their other broader IT infrastructure, and that's another competitive advantage for a company like Dropbox. So overall, we see a lot of green on the company's 7-part framework and 2 concerns area. One is the negative return on equity, and then the other one is that we don't get a chance to buy an extremely cheap stock at this point. So in order to get another data point, I look at what was known as Rule 200. And Rule 200 is a methodology that venture capitalists use mostly in financial technology sector in order to evaluate whether this company has all it takes from its revenue, retention, margins point of view in order to become a rapidly growing value creator business for their investments, for their portfolios. So I usually apply that to my investments, especially if it's in software, service, or technology sector. And that gives me another data point. The formula is that you take the month 12 retention of the company, meaning that if a customer started paying Dropbox today, whether that customer stays with Dropbox 12 months from now, what percentage of the customers in terms of their dollar value of the money that they pay to the company stay with Dropbox after 12 months. It's revenue growth, it's gross margin and operating margin, and combine all of that together. And if it's more than 200%, that's historically proven to be a very rapidly growing and value generator company in venture capitalist portfolios. So for Dropbox, the very first data point that we got is the operating margin of 14%, gross margin of 80%, and revenue growth of 25%. From what we've just looked at. And then the part that is concerning, it's their revenue retention, 12 months revenue retention. I wasn't able to find that number in the latest quarterly earnings, which tells me it's something that Dropbox is working on. If they're not sharing it, it means that it's probably not moving towards the right direction. I found a 90% figure in some of the previous quarterly earnings, and I don't know what it is right now, but again, if they're not sharing it right now, that's an area of concern. But if you put it in the formula, altogether it gets to 209. It's not extremely crazy number, but it's also past the threshold. So it's a similar story to what we saw in the 7-part framework. There's a lot of good things happening for it, but there are areas of concern. So let's wrap up the story of Dropbox as a part of our 100 bagger stock analysis series. But before we get there, I want to tell you about a really good news about Stockcard. So we are a finalist in Benzinga's annual fintech award in the best research technology category. I'm very excited about that. It basically tells us that the industry is getting to know Stockcard, and other fintech founders and investors recognize Stockcard's technology as one of the best that any retail investor can use. So that's a really good news. We're going to hear whether we win it or not in December. So fingers are crossed to basically win and become the top of the list on Benzinga's best investment tech platform in 2022. But even before that, there is an opportunity for you to support us and get involved. We are running a fundraising campaign on Republic. So you can go to republic.com/stockcard and join a Stockcard as an investor, and hopefully be a part of the future we're building for retail investors like you and me, myself. So once again, a Stockcard, invest in a Stockcard on republic.com/stockcard. And I really hope you become an investor in our company and be part of the future that we're building for retail investors. All right, now let's go back to Dropbox and just talk about the final thoughts and ideas on Dropbox. I don't own Dropbox, and based on this research that we just did together, I really doubt it becomes a 100 bagger stock unless it can really figure out that return on equity problems. And also I am a little bit weary of its current market size and how much opportunity exists in the industry. Of course, there are ways if it starts acquiring different kind of businesses that kind of expands its total addressable market to other aspects of file storage and file sharing and increases that addressable market, there is more hope in there. Or if we get a chance to buy Dropbox at a much lower valuation at some point, that could also be an opportunity to become a 100 bagger. At this point, I really doubt it. It is a really good stock. It could become a 5x return or creates a couple of percentage return for you in portfolios, but I don't believe it becomes a 100 bagger. Things that I would watch for if I own this stock or if I would invest in it is that what is the net revenue retention rate, which we discussed was about 90% a couple of quarters ago. So we do want that to improve more than 100%. We do want to make sure the company grow its revenue maybe as fast or even faster than the 25% in the market. Right now, its growth rate is lower than the market. And then obviously, can they turn the shareholder equity to positive as opposed to negative? Those are things I would watch in the next quarterly and annual returns. And with that, thank you very much for spending this time with me. Please make sure to like and follow and support us. That means a lot to Stockcard because we can spread the word of intelligent investing to more stock market investors as a YouTube algorithm sees that you like our content. Like and subscribe and share with your friends, and I'll see you next time. Have a great day.